Okay. So I know it's the afternoon. People tend to get a little tired, but I think we've got the best group in the house here. And I'll start with a little preamble to explain why I think this is worth your next 40 minutes. And I think the main word is magnitude. You know, so many of us started with stablecoins when it was a little more of an experiment or kind of a pet project for someone at a fintech company. Today, it's a completely different world. I think you saw Brian Armstrong reposted a tweet last night that said stablecoins had finally reached 1.1% of the US M2 supply, like 240 billion, an insane scale that a couple of years ago we probably would have thought would be like the most bullish of times. You have 250 million addresses that have interacted with the stablecoin over the last 12 months. We're run rating at more than Visa's volume now. And the asterisk here is that this is all before we have actual regulation that can enable, you know, real capital to come into the space to the tune of trillions. So if we're getting here now, and we kind of saw the update of the Genius bill last night, it excites me to think where it will be even, you know, 6 months from now. And so I think with that, it would be great to, you know, one, start with a quick intro from each of you on what you do, and then specifically how it relates to our topic today, which is stablecoins and fintech.
Hey everyone, thanks for having me here today, Huma Finance and Josh. So I'm Anthony. I'm the co-founder of Artemis. We are a stablecoin data provider trusted by Visa, PayPal, Circle, Solana, and more. And before Artemis, I was one of the early engineers of Venmo and built a lot of the backend infrastructure and scaled the company to over 150 million users before jumping over to being a founder.
Hi, I'm Chuk. I'm on the product team at Paxos, where I lead a range of things, but currently money movement that includes on-off ramps and payment use cases. So really glad to be here today. I think the prior session from Ronak gave a good overview of what Paxos does, but in a nutshell, enterprise blockchain infrastructure, including white label stablecoin issuance, brokerage, custody, and of course, money movement.
Hey everyone, I'm Joao Reginatto. I'm Chief Strategy Officer at M0. At M0 we call ourselves the universal stablecoin platform, and what that means is that we are a platform for developers, builders, you know, the long tail of people eating glass and staring into the abyss. Is that what they say? To build their own application-specific stablecoins and embed that into their use cases. And I'm going to say why I think that's extremely important. Before working at M0, I spent 8 years at Circle. I led the build out of USDC, so I know a thing or two about the V1, the first era of stablecoins, and I think we're going into the second era now. So excited to talk about that.
Hey guys, my name is Raj, co-founder of Portal. Portal is a stablecoin developer platform. We enable enterprises, startups, early stage companies to build products and services around stablecoins. We've got like every, as I joke, boring payment use cases from freelance platforms, neobanks, to payroll, to B2B payouts. We're seeing stablecoins kind of eat a lot of traditional payment use cases, and we enable the building blocks for it. Excited to chat further.
Awesome. So I want to zoom out. I think, for folks that see the industry from afar, it really looks like a duopoly between Circle and Tether. And my question for you is, as institutions start coming into the fold, do you foresee that they will launch their own stablecoins, or will they adopt, USDT, USDC, assuming there's some type of first mover advantage? The contra case is that these institutions generally have very strong distribution that they can tap into, which kind of calls into question whether an issuer as a service model actually makes more sense. So I guess, Joao, would love for you to kick that off.
Yeah, I have a few opinions on that. I think it definitely has been a duopoly, right? And I think I am a big believer of first mover advantage, not from a presence in the market, but I think of a presence in people's minds, right? More from a marketing point of view. I mean, Tether will always be the first stablecoin USDC for Circle will always be the first trusted stablecoin. And then, each one of these products is not exactly a competitor to the previous one. They always iterate a little bit. And if they are the first mover in that iteration that, gets into people's minds, they will succeed. And I think we're going to go through a new phase that will create space in people's minds, developers, builders, business leaders, decision makers, that they actually will realize that just as we have seen again and again waves in technology, people tend to gravitate towards customization. People tend to gravitate away from one-size-fits-all solutions. And I think, and I was part of that first journey, as I said, how do you put $1 on the internet, right? How do you digitize $1? And I think, there was a way for people to do that, and there were articles written about how to construct the reserves of a stablecoin and how to maintain a peg. And if you guys realize that's all in the past now, nobody talks about those things anymore. It's like, yeah, whatever. Like, sure, we know how to do that, right? The question is now, there's a lot of conversations around programmability, right? Around how this infrastructure can actually enable things that just were impossible with analog dollars or electronic dollars before. Digital dollars are fundamentally different. And I think we can't quite fathom what people will build with this infrastructure into the future, but we believe that it will be the next backend for fintechs, right? In the same way that if you build a fintech for anyone who has done this in the past, you have to find your banking partner, right? And you have to kind of lower your risk appetite to their common denominator. You got to find your payments processing partners. You got to struggle to, again, talk the same language. But effectively what you want is you want to take the dollar and customize it for your use case, right? I love to use Starbucks as an example. The Starbucks app is the dollar that becomes super constrained for that use case, right? I don't get any savings from the dollars I have on my Starbucks app, and I can only spend it on coffee. That's customization. That's customization of the behavior of the dollar. I think that's effectively going to be a huge direction for the market now, is that people will realize that they can now build fintechs for a fraction of the cost, for a fraction of the time, if they build it on stablecoins instead of the traditional banking stack. And they will want customization. And so to answer your question, I think the growth from that 250 billion to the 2.5 trillion and then 25 trillion maybe, it's probably not going to come from these one-size-fits-all solutions. It will come from iterations of that allow for customization effect.
Chuk, do you have anything to say there?
Yeah, I think you nailed it at the beginning in the intro. We are still so early. The regulation across the world still hasn't come into fruition yet, and you choose whatever TAM number suits your particular use case, whether that's offshore dollars in the euro dollar system, that's 13 trillion, whether it's the TAM of M2, 200, if it's cross-border payments, 200 trillion. We're in the trillions. And so when you think through each of those use cases and segment by that particular user, then there's a whole other set of market opportunity available that doesn't necessarily fit what Circle and Tether solve today. And so, you're right for sure that Tether and USDT is the original stablecoin in terms of on the blockchain and transmitted in the way that it does. But in terms of the job to be done, it's just a digital version of the dollar. And we've had that for decades. Whether it's PayPal, whether it's mobile money, there are lots of other use cases, particularly when companies have distribution and held capital, whether that's a marketplace, a gaming, and other ecosystem. There's lots of other pools of capital where this is just another evolution of a digital dollar, and that's what's going to drive a lot of the adoption going forward. And then there's the question of interoperability between these limited Starbucks bucks versus PayPal dollars versus the Fidelity dollars and all the other dollars that will be coming online on-chain over the future. How will things be interoperable with each other? That's a good question. And where Tether and Circle may still have an advantage in the sense that so many players and ecosystem partners have already integrated those. That could be where they maintain dominance, being that interoperability layer. But in terms of the large pools of capital that are digital dollars that will be on chain, there's so many more use cases to get to those high trillions of numbers that we mentioned, that it's easy to see how Circle and Tether no longer have their dominance.
I also have some like spicy takes from the data that I looked at this morning. So definitely for sure, very early. And two, there's a duopoly. So both Tether and Circle have been growing supply. And actually, all the people who were sort of like first-gen stablecoin issuers that are not Tether and Circle are getting absolutely crushed. And if you look at who else is winning, it's all the new players too. So like in our dashboard, we grouped all these other folks under other, and 2 years ago, it was 0%. It was basically just like Circle, Tether, and a bunch of like legacy stablecoin issuers. Now it's up to 5%, and it's growing it's going straight up. And so I think it's very early, and it's going to be very exciting to see like sort of how this these new players will shake out.
No, very interesting. I mean, anecdotally, I see the same as well. I think what's interesting too is when you add the distribution element of fintech. If a user's just seeing USD, I mean, are they really caring what's on the back end? And if you can bring that aspect of programmability, which you mentioned too, and I want to get to next, I think you can unlock all these benefits, whereas both the fintech and the user actually win. But then, you can't do that with a one-size-fits-all stablecoin. And it's that programmability characteristic. I want to put a pin in it. Fintechs like Stripe, Revolut have brought so many great innovations to the consumer experience. And when we speak about stablecoins, often we're nerding out on like speed and cost, but programmability is a really interesting one as well that doesn't get as much coverage in my opinion. And I would love to hear from you on, and compared to a closed kind of Swift system, what unlocks do you see us getting from programmability? What are some examples where money can now do 10x more because it's a stable coin, not a dollar?
Yeah, I guess a couple of different examples. I mean, one of our customers is building a product out of Argentina for import exporters, and it's an interesting workflow where in order for the shipment from Europe to get shipped, the exporter needs to receive that dollar or that some type of capital before they release this large shipment. And so before the Argentinians would take 2 to 3 days, maybe 5 days with Swift. And now it disrupts the entire supply chain process. And then once it hits, the shipment gets pushed afterwards. What they're doing now is they're actually using stablecoins. They're saying, cool, let's just ship there. Let's just send that stablecoin over to that exporter same day. Shipment is now released. And that's actually improved the entire workflow of the supply chain now too. And now you can build more programmability in terms of how you cut deals with your exporter now, where you can say, hey, I can give you 50% up front. I can keep some in escrow. And the logic actually starts to build out pretty quickly from there. So that's just a simple example where it has a pretty real, I think orders of magnitude improvement on the supply chain process that we were just not able to do because there's no APIs into Swift, or you can't push Swift to go faster. But now you can build really bespoke workflows, logic into the system, and now you can actually improve your entire supply chain process also. And then I'm just talking about supply chain. We haven't even got into all the other use cases that payments typically dominate as well. But that's just a small glimpse of what I'm seeing actively take place with some of our customers today too.
Yeah, I'll give a more generic answer because I think honestly, we as humans we're pretty bad actually at predicting the future, right? If you look back at only even the last 30 years of the internet, has anybody predicted kind of the waves, mobile and now AI? No, we didn't, right? We kind of now we can connect the dots and be very smart about it, but we couldn't project it. And I think the same thing will happen. I think in the same way, again, the way I like to analogize is look at trends that happened in the past and what foundation was there. And I feel like we have a foundation again. So I think we are making a couple of bets that the way that stablecoins have been designed up to date have been, again, pretty bastardized, pretty simplistic, right? Actually, what digital dollar technology allows you to do is to kind of separate this concept of a digital dollar into two components that I think were not separated before. One is a value component and one is a behavior component. And if you build fintech, there's a huge amount of code you need to put in place in web servers and a bunch of other places to craft the behavior. And then the value component of your fintech is usually the FBO account that sits with your banking partner. Now, all of a sudden, it's all, to use an EVM concept, it's all in a smart contract, right? Like the value component can be separated out and pretty pristine. And, as I said before, like there's no innovation to be done there probably anymore. It's like how the reserves of that asset are gonna work. But the behavior can be instantiated almost at the point of usage, right? You can take, and you could do that with USDC, with whatever asset, we call it M for our value component. You can take the asset that is very vanilla, represents value, and say, okay, for this transaction now, I'm going to mint another asset that has this and this behavior. And most people are like, well, you're starting from the technology. This is bullshit, blah, blah, blah. But if you think about it, that's exactly the trend that we saw with, for example, mobile and various other things in the last 30 years, right? It's like, oh, now you can write part of the code on this device that's actually close to the end user, can work offline, has all these other sensors, super localized. What can you do with that? And a lot of companies said, yeah, whatever, like this is just a toy and we're not going to be worried about it. And you had other companies like Facebook who said, Jesus Christ, we need to move all of our development to this platform because it's going to change. And it did change like completely how people use applications. So I think if you project into the future and think that every usage of the dollar can have just-in-time programmability, and to have just-in-time programmability, you simply cannot have a centralized issuer, right? The only people who can program USDC are sitting at Circle, right? So the programmability of USDC is constrained to Circle developers. Why is that? That shouldn't be the case. Stablecoins should be bespoke to every use case, potentially bespoke to every transaction as the technology gets simplified and commoditized. And then the developers should program for their use case. And maybe even without knowing, the end user will program the usage of a stablecoin at that point in time. As a parent, in the future, maybe I'm going to give an allowance to my kids on a weekly basis and say, oh, this week, spend 20% less in candy. And by the way, if they don't spend this money in a week, reroute it to their savings account. And I will program maybe with an AI agent, like they're on the spot, and that will be like an instance of a token for that spend that I make with them. Stuff like that. I don't know if that's going to be useful or not, but when you have like thousands and thousands of developers playing with this, eventually the next Revolut, the next Square, these companies are going to come out of that infrastructure because it's so much easier to build, so much faster to build.
Yeah, no, I agree. I think, everyone here is very passionate about, as I said, programmability, but then even more so the speed, the cost. I do want to flip the script a bit for a couple questions and talk about where we face the more real problems trying to implement this vision. I think the one that we come across when we're chatting, in our calls or group chats is the liquidity side, especially as it pertains to, interacting between one country and another. And part of that is just the regulatory regime isn't in place to allow banks and other large liquidity profile firms to come in. But if you kind of route money, for example, to, Argentina, sometimes on these order books, like 5 million will delete the whole order book. And then you start to have to use, certain market makers or liquidity providers, and then costs come back, and then the opacity increases, and we're kind of back a little bit to square one. Why does this liquidity issue exist today? How are we going to fix it? Chuk?
Yeah, so, the blockchain technology that stablecoins are built on is a technology, and it solves the technical aspects of moving value quickly, but that's only one aspect of the problem for international payments. And the rest of those problems are capital problems, and liquidity is one of those. Not only do you need to have the liquidity at the right place at the right time, it needs to be provided in a way that works for the incentives of the providers, whether that's the market makers, whether that is the orchestrators, the companies themselves. And so there's a range of incentives that are not purely a technical problem. And so when you look at each of the key corridors and markets, over time, it has started with crypto exchanges with heavily traded pairs of USDC or USDT to a local currency. But that only solves so much liquidity. It only solves certain types of payments. And it takes time to bring the experts, who typically are traditional OTC or banks or other FX players into this market. And we're starting to see that more and more today. There are a range of players. Some call them orchestrators, some call them liquidity providers, some are branded under the PayFi umbrella, for which we are here today. But there is a long kind of adoption curve of getting the right amount of capital plugged into the various different sources in a way that it can be optimized and served to where it's needed. Doing that in a compliant way, where in each region or each corridor, there are different rules, and some of them have not been adopted quite yet for digital assets, and doing that competitively in a way that's capital efficient. So all of those problems are not technical, are not blockchain solved, but it's happening over time, and I think as we'll see as traditional players and institutions come into the market, they bring with them liquidity because they see that there's money to be made. That's fantastic. And as regulation develops, starting in the US, not starting, but driven by the US, because many financial firms across the world kind of follow the US's lead, that will bring even more institutions, and that will solve the capital and coordination problem.
I'll just piggyback off of Chuk real quick, but in terms, for me, like I see a lot of different use cases, a lot of different builders and developers, and so I'll just give like another tangible example. But back in 2022, 2023 time, there was a builder that came to me that was trying to build a stablecoin product between US and Mexico. And, big corridor, $60 billion, one of the largest remittance corridors in the world. And then during that time, kind of similar to what Josh mentioned, he was trying to move money between the US and Mexico over stablecoins. Of course, the order book filled up. And he was like, hey, what happened? The unit economics don't make sense and don't work. But over time, I kept tabs with this builder. And if you fast forward to today, like Bitso does about $6.5 billion in stablecoin volume between US and Mexico, which is about 10% of the corridor now. And so what became 2-3 years ago, 1% of the corridor just in stablecoins, very inefficient, is starting to evolve now and snowball where now it's about 10% of the corridor. And so I think to Chuk's point, the technology is there, and typically markets are fairly efficient, and over time it takes folks I think there's a lot more market structures to get built around these things. And to exactly Chuk's point, now Bitso does about 6.5 billion or so in that same corridor, and so. I think some of the stats that we saw beforehand, where these circulating supplies, they grow from 200 billion today to potentially trillion. It may feel like it's moving really slow, but when you start to stack these years together, it starts to move in an exponential pace. And so I think that's something that just a tangible example I've seen from a U.S. to Mexico remittance corridor, just as a tangible example there.
I do think also there is some part of a technical problem in that I think crypto people have a tendency to think that AMMs solve everything, but they just sometimes don't. And so in this case, so we work a lot of stablecoin issuers and DEXs as our customers, and if you're going to issue a new stablecoin, especially something that's not US dollar based, you're going to have to bootstrap liquidity for all these AMM pools, and it's just cost prohibitive. And so I think but then to sort of Chuk's point, the solve isn't to build more AMMs. The solve is to actually do the business development, the working with banks, the working with OTC desks, the working with market makers. And so, for example, I think the Mento Labs team is doing something in that vein with Solana, and they're chain agnostic, so they're doing it with a bunch of chains to work with these market makers and OTC desks to make sure that these long tail non-USD stables have enough liquidity so that you can, you're not going to blow up the order book.
No, I agree. And I think one observation I'll add is we're kind of in this tough spot where on-chain pools of capital don't earn enough yield interacting with stablecoins because they can do, very high risk activity in our space. And then the traditional FX liquidity providers can't go into our space because of the lack of regulation. And you kind of have this setup where there's some brave, startups or perhaps domesticated in other countries, companies that can feel comfortable with the law to do this. But once you enable that regulation and you get more capital in, it all is very reflexive. It just starts building on each other because then there's enough volume, so the APYs are enough. Then you can supply liquidity, and that deepens liquidity even more, which means more volume can come. And so I think I'm hoping and I'm betting professionally that we're on the cusp of unlocking that, because that's when you start to see things continue to scale exponentially. And given that we're coming off 240 billion and not 5 billion anymore, the next exponential unlock is truly large.
Yeah, and one thing I'll just add to that, there's a huge benefit of legislation this year, Trump and the pro-crypto administration, and then particularly the Stripe Bridge acquisition that has created a Schelling point for this type of market ecosystem to develop. As mentioned, it's really a market problem. It's a coordination problem. And how do you get disparate partners and parties to coordinate and share incentives? And part of that is distribution, is communication, but the quote unquote hype of the stablecoin hype that we're in today, whilst we may seem to be ahead of ourselves in terms of what is being promised versus what is being delivered, that hype is a necessary ingredient to bring people together and start to find and fish out these different ways to make money. Really, that's what it comes down to. Can you make ROI on your capital? If I can do that by providing liquidity in this place because there's lots of volume in this corridor, then I will do so because there's lots of different economically incentivized players. And so the more that there are conferences and summits like this, the more hype that brings people in, brings fintech and traditional players to say, hey, let's go explore that stablecoin route because I hear we can save money. It will bring people together into a point where then you can pool that liquidity and get the economics in a place where the volume will start to just grow. And that'll attract more liquidity, more volume. And so that people are making money from just supporting trading rather than having to rely on DeFi yields and other things that aren't necessarily familiar for these traditional institutions.
Yeah, no, I think we all agree there. Something you alluded to is, the influx of talent, more attention, especially after Stripe Bridge. I can vouch for that myself too, and it's been a great contributor to a lot of the new companies that have sprouted up in the last couple months. But with that as well has come a little bit of fear, I've noticed, and I've discussed this question with several of you before. But when I get asked by traditional investors and more traditional VCs, they're looking at this, they see that it costs 10 bips with Bridge to move money, for example, and they're essentially saying, well, all right, this is kind of the end of monetization. How are these stablecoin businesses themselves going to generate returns? But more importantly, how are the incumbents and those that adopt stablecoins going to be able to maintain their margins and kind of revenue profiles? Curious as to how you would think through the value generation that comes from stablecoins. Where does it move in the stack? What does a business model look like 5 years from now? Raj?
Yeah, I mean, there's I think we've seen there's a huge change right now just happening in the ecosystem where a lot of the value accrual, historically has been the stablecoin issuers themselves, but we're seeing that flip now where there's a lot more app builders out there. There's a lot more attention from banks, from fintechs. And ultimately and I think price compression is actually a embedded benefit as well, where the same operation that, maybe a large marketplace was, doing to make payouts today to be a lot more expensive can actually be a lot cheaper as well. So I think it comes on both fronts. And I think the other part of it is as a circulating supply hits the trillions and in 5 trillion, 10 trillion, even capturing, you can think about it from an interest standpoint, just sharing economics and interest of a $3 trillion pool. That's quite massive. Even if you're third or fourth place in that case, kind of feels good to be in a big market where you can earn a lot of capital also. So the sheer I think magnitude of the markets that we're seeing explode with stablecoins, and even if there's 20, 30 players that are in the space, if it's actually not that bad being some small percentage of that as well, where if you look at the profile from just a strict P&L standpoint, it's actually still meaningful. So I think that's the embedded bet, is that price compression still benefits the apps, the marketplaces, the folks that are actually moving money, but also the pie is so large as well that even a small percentage actually makes a ton of sense too.
Yeah, I agree with what Raj said. I think the trend that we see in the market is that if you're a developer starting today, right, and you're going to build something like a fintech of sorts, or sometimes not even a fintech, sometimes it's just any other type of application that has to embed a dollar in them. And if folks are somewhat crypto native, that they know that they can use a stablecoin for that, a dollar stablecoin for that, they're actually not going to the incumbents, right? They're actively, I wouldn't say that's a rule, but we're seeing so many people who are actively rejecting the one size fits all and the incumbents, right? And so that's why I think, and I don't mean, obviously all of these things are nuanced, right? I don't mean that like Circle is not a good business. I get asked that question all the time by investors, right? Or Tether is not a good business. They're clearly good businesses to some extent. They might be bad on some other things, but they're clearly good businesses in multiple dimensions. But it doesn't mean that you are not going to find other ways to build good businesses as well. I just think that from a model point of view, that model of the very large incumbent stablecoin issuer that doesn't really have sort of a finger on distribution is just not going to exist into the future. I think we're going to see. I actually think USDT and USDC into the future, they behave more like payment rails, actually. They have accumulated so much network effect and so much, we were talking about liquidity, right? All of the liquidity in the market is in these two denominations. It's not in any other denomination, despite all the innovation and creativity that we see in the space. The pockets, the pools of liquidity are always still in these two denominations. Which, if you think about it, is very similar to how payment rails operate, right? But then you get to a use case, and then on the use case, you might want to switch over from the payment rail to something that is more bespoke. And I think that's where we will see the innovation in terms of business models. For example, at M0 is a network of issuers, right? So we are onboarding the second issuer. It's a company called Braille, domiciled here in the US. They have a couple of dozen people on their team. The first issuer on the network has a dozen people on their team. So guess what? Flash news. You can run a stablecoin issuer. Our network is already at about $250 million in supply. You can run an issuer with a dozen people. And it doesn't mean that you're not doing anything that you should be doing. It just means that the technology is getting concentrated on the automated part, and you don't need a team of 250 people in compliance. You don't need a team of 250 people in risk. Maybe you can do with like a tiny fraction of that. And again, it's the traditional waves of technology and how it shifts the allocation of people, particularly now with things like AI compounding the effect. So I think if you think about it, then it's not going to be profitable to run a stablecoin issuer. It might not be profitable if you try to replicate the structure that you have today, but if you can run a stablecoin issuer for like 250 million of scale with 20 people, it's actually extremely nice of a business to run. And I think that's where the shift is going to be. And we're going to see like loads and loads of those, I think.
Yeah, I absolutely agree. The short answer to the value accrual question is it depends. And if you're a VC, the focus is on which market for which use case, particularly in which region. And so this is not a really good one-size-fits-all answer. But the closest thing to a one-size-fits-all answer, in my opinion, is distribution. And treating stablecoins as just another technology is not a new market where there's some unique way that value will accrue. It's looking at the businesses that own that on the one side own the customer, own the end user, the individual, or the business or the merchant, and it's just using technology as another way to provide value-added services better, like solving those user problems, so that at the end of the day, the user isn't thinking whether I'm holding a stablecoin or not. It's, can I run my business? Can I make that payment? Can I pay my friend or my colleague? And this application just makes it easy. And so when you think through all the folks today who have distribution, either say like folks like merchant acquirers like Stripe or consumer wallet applications who already have that user base, all of a sudden this new technology has just enabled them to provide a full stack of financial services, and they can all become banks, capital markets, trading, everything, full service, kind of super applications. And looking at it from that perspective is, if you're in the market right now, yes, there are opportunities to like sell shovels, to sell infrastructure, because so much of the infrastructure needs to get built. So depending on that particular region, that particular nuances, yes, there's value to be made. But in general, can you own the customer? And that way, over the long period of time, they are going to continue to add services and provide value there. So for me, there's lots of nuances and ways to find value in different parts of the infrastructure stack. depending on the region, but kind of like the cardinal rule in all of business in general is distribution.
No, I agree. I think to summarize, there's a similar paradox with compute, right? Which is the cheaper compute is, the more compute there actually is demand for. And I think, Raj, you kind of were guiding us there, which is if we can make it very easy to do things with money, more people will be doing things with money. And then I think I'll add a corollary to that, which is that AI agents, not to throw out a buzzword, but I think there's no other financial system that can work better with that set of primitives than stablecoins on chain. And so I think that's where you'll just see our volume as a financial ecosystem globally rise exponentially to kind of cover the lack of take rate. And I think your point is a good one too, Chuk and Joao, on basically understanding that everything has nuances, and where businesses can command distribution and some form of defensibility, you can monetize, but mainly through value add services, which we saw kind of the payment networks move towards over the last 20 years. I think in the interest of time, perhaps to leave things on a bit of a spicier note, would be curious for each of you to walk through your most contrarian opinion on stablecoins. And I don't know if I'm allowed, but feel free to shoot shots wherever, because I think it would be a great way to end things. And so it's all an intellectual debate at the end of the day.
Okay, I'll start just in case someone takes mine. I don't think this is potentially controversial for folks who are in this room or deep in the space, and who, I'm grateful for the folks who read some of the stuff that I write. But I think for folks outside of this room, stablecoins are a killer of Visa and MasterCard. And so my controversial take to that is that they're not at all. There's a lot more benefit that stablecoins can derive from being connected to Visa and MasterCard cards in the next, call it 5 to 10 years, than stablecoins doing the end around Visa and MasterCard, because they provide way more value than just being a settlement layer. And there's more to go, but I'll pass on to someone else.
Or I'll go. I guess I don't know how much of a hot take this is, but just working with many developers and users don't care about stablecoins, and they might not never actually even know that it's a stablecoin underneath the hood. And I kind of think of it as equivalent to how you use your card today, you buy a cup of coffee, you swipe it at the coffee shop, the merchant gets paid, you've paid from your bank account. Most folks don't even know how Visa works today too. We're starting to see more and more of these apps and these builders take away the C, the G, or any other letter that you see behind the stablecoin ticker, and so that's my more of a hotter take as well.
Yeah, no, first of all, I just wanted to say that I really like Chuk's point, and that would have been one of my potential answers. I also think the converse is true. I think Visa and MasterCard stand to profit a lot from the fragmentation of stablecoins, because as a former engineer, I always saw Visa and MasterCard also as a converter of money formats, right? And the more money formats we have, the better for them. And I think we'll have a lot more than what we have today in whatever period of time you want to pick. My hot take will be a shot on regulation, because we like to talk so much about regulation, and I don't like to talk so much about it. I prefer to build and have regulation follow. I think the term that was created in the US for regulation, payment stablecoins, there's a lot hidden in there. There's a lot of interest hidden in there, and my take is that stablecoins are not a payment instrument primarily. They are money infrastructure.
Chuk and Joao are really lucky because I have data to back their hot takes, and it's absolutely true. So we recently looked at crypto products by retention, and card products have 4x as much retention than any other crypto product in existence. And so, yeah, I think it's very great take. My hot take is actually quite hot because I'm at a Solana Foundation event, but the number one winner right now still by a long margin is actually Tron for stablecoin payments. And I feel okay saying this because it's backed by data. It's not like I'm making this up.
Our next speaker is Justin Sun, so just no.
And so I preface this because we are coming out with a new report in 2 weeks where we surveyed actually 20 of the top stablecoin PSPs and orchestrators, and to understand what chains, currencies, and use cases they're supporting. And this is all off-chain data that we're aggregating and anonymizing, and this is kind of a preview of what we see. It's just like it's insane. Like I'm very bullish Solana as a low-cost chain, but like right now the incumbent is by a long shot like Tether on Tron. There's no second place.
I'll just add one more thing is that so before building Portal, I was at Visa, and we launched stablecoin settlement 4 years ago, and no one seemed to care back then. So when folks talk about stablecoins being a Visa killer, is like Visa, we tried that like 4 or 5 years ago, and I remember getting laughed out of many rooms for showing a $20 million circulating supply. Where fast forward 5 years, it's not so tiny anymore.
All right, round of applause for everyone. Thanks for having us.